Welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is an amazing way for you to exit highly appreciated multi-million-dollar exits, crypto, businesses, commercial real estate, eliminate the need for the 1031 exchange so you can create and preserve more wealth, and invest in a flexible way with multifamily or mobile home park or car wash operators. Diversify into commercial real estate assets that make a lot of sense. In fact, I say that because today I'm joined by an amazing guest. He's got an extensive background in investing into real assets such as real estate. And after a handful of successful businesses, which resulted in significant tax liabilities, he became intrigued with how to legally reduce his tax liability and dedicate himself to learning the intricacies of the tax code. He educated himself on the topic, surrounded himself with experts in the field, and sought investments in asset classes and with operations that would not only benefit his tax situation, but also provide strong returns, protect and build his wealth. He and his team at the Real Asset Investor have placed more than 800 million in various asset classes, which offer cash flow, tax impact, and equity growth for investors. By the way, we're also streaming on Expert CRE Secrets, so we appreciate everyone out there. And I also forgot to mention, if you don't know who I am, my name is Brett Swarts, founder of Capital Gains Tax Solutions. And every episode, we're bringing on some of the best real estate, financial, and tax minds in the world, where they share their ideas, deal stories, and inspiration. And today's guest will not disappoint, I promise you. His name is Dave Zook. Dave, welcome to the show. How you doing?
Hey, I'm doing good, Brett. Thanks for having me on the show.
Absolutely. And I had the privilege and the honor to meet you down at the Family Office Club down in Fort Lauderdale, where you spoke on stage and I spoke on stage. And that was like really cool, because all of a sudden looking up and going, whoa, there's some really amazing people that I get to speak with. And I'm still building what I'm building, and you built some amazing stuff. So I'm so excited to have you on the show. For our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah, so I grew up in the modular building business. And as I was growing up, kind of working through all facets of the business, I ended up becoming a co-owner of the business and building several other businesses along the way. And as I was, getting into my 20s and early 30s, some of these businesses started doing really well, and I ended up paying a lot of tax. I ended up having a $500,000 annual tax bill, and I just, the more I thought about it, the more I kind of despised it. And I said, I got to figure out a way how to keep the money that I earn, not just make more. And so I went down the rabbit hole, and I got around people who were making a lot of money, making more money than I was, and paying very little or no tax. So I had really made up my mind early on in my life that I wasn't going to be a real estate investor. I'd watched my dad invest in real estate and self-manage some single family homes. I just decided, it's not going to be me. I'm not going to be a real estate investor. But when I realized that these people were using real estate to offset the tax liability on their income and their gains and all that, I became intrigued and went down the rabbit hole. And I quickly went from not wanting any real estate to wanting most of it. And I bought a lot of multifamily apartment complexes. I bought several hundred of my own, ran out of my own money, and then I tapped into family, and then after that, friends, and then after that, business associates, and pretty soon I became a real estate syndicator, really by accident. I was really just in the deal flow, and I wanted to buy more real estate, and I went from paying $500,000 in tax one year to paying zero tax the following year and making more money at the same time.
It's absolutely amazing. And we're talking with Dave Zook, by the way. If you want to learn more about Dave, you can connect with him right now by going to therealassetinvestor.com, therealassetinvestor.com. Dave, before we dive into some of the secrets to investing in assets for tax-free cash flow, I do want to take one other step back. I want you to go back to the younger days. I believe we've all been given certain gifts in this life. These gifts have been given to us and be a blessing and help to others. So I'm curious, what would you feel like your number one strength or gifts that you've been given, and how does it help how you help and bless people today?
Yeah, so strengths, I'm an extreme visionary. In fact, if you do the tests, the personality tests, I'll show up as a visionary, kind of a leader. If you're a DISC profile, I'm the D, I'm the DI. And I've been, in our companies, I'm kind of known as the rainmaker. But our personalities, and I'm very familiar with them now, which is helpful. It can be damaging if you're not. But our personality is the kind that we go out and make waves. We can also make a mess and raise havoc as we go. And so I quickly realized that I need a C personality, or somebody that's detailed and really into the details close by. And that's been a game changer for me to recognize my personality, my strengths and my weaknesses. And so I really operate best at the top of the funnel. I operate best when I'm at the Richard Wilson Family Office Conference, and I'm talking to high level, high net worth investors, and I'm getting deals done, and I'm coming, of course, then it takes a team to kind of put the pieces in place and make sure everything's running smoothly.
Absolutely. So I would say, I think your strength is knowing thyself, and then knowing your strengths and knowing how to get others to complement the areas where you're not as strong at, and then using that to help more people build businesses, create and preserve more wealth. Is that a fair summary, Dave?
Perfect.
Excellent. So now let's dive right into the topic at hand, which is investing in assets for tax-free cash flow. So Dave, what is the number one, maybe not as thought of secret to investing in assets for tax-free growth?
Yeah, so as you can imagine, going from $500,000 a year to zero while exponentially increasing my income, tax is near and dear to my heart. And so I'm always looking at asset classes that will deliver me the depreciation that I'm looking for. So early on, and this is probably starting back about 11 or 12 years ago, I started investing in ATM machines, and I'm really a serial investor. I'm by nature a pretty positive person, so you paint me up a nice story and tell me a great story, I used to fall for all of them. Fall for much fewer of them these days because I've learned my lesson along the way. But I'm looking for assets that give me a couple things. I'm looking to build wealth. I'm looking to build my income streams, and I'm looking to keep the money that I'm earning. So let's break it down for an ATM investment. Then I'll talk about car washes as well, because they're pretty unique as well. But when you invest in an ATM machine, by the way, we're top 4 in the country in the ATM world. So if you see an ATM out there in a convenience store, there's a good chance it might be one of ours. So we're one of the top 4 ATM operators in the country. So when you invest in an ATM machine, you're buying equipment, and then you got to look at the tax code. Okay, well, what does that mean? What does buying equipment mean for me from a tax perspective? Up until last year, up until the beginning of this year, you could write off 100% of that in year one. Now it's 80, as you know. But you get to write off 80% of that in year one. So if you invest $100,000, you automatically get an $80,000 loss in year one that you can use to protect yourself from, let's say you sold a building and made a profit, or let's say you've got some other passive income, or let's say you got depreciation recapture. That's a big one. 80% in year one is a big deal.
Absolutely. Yeah. ATMs. Wow. Top 4 operator. That's awesome. So, right. Doing like what Section 179, accelerated depreciation, and doing the bonus part of that to be able to write that off. So you can put $100,000 in, offset, $80,000 in year one. And that can also carry forward. Dave, talk about that, or the next best secret to tax flow free investing.
Yeah. So what you don't use, okay. So let's say you made the investment, and look, I don't like making investment just for the tax impact. It's got to be a great investment. It's got to be an investment that either builds your income stream, or builds equity appreciation over time, or has the potential to really escalate and make some capital gains profit. But really, what we do is we take that tax impact and we use it to offset other income. You align it with other income streams. And if you can't use all of it or any of it, I mean, there's no way, there's no bad way to use depreciation. Like if you can't use it in year one, it just rolls forward and it keeps rolling forward until you get to use it. I think you got like 24 years to roll it forward. So what I usually tell people from an ATM investment, if you did nothing and it just sat there in your depreciation bucket, you could wipe out the tax liability on the income coming from that investment. So it doesn't go to waste, even if you don't use it in the year one.
Okay, let's also talk about maybe you had some other income from some real estate, right? So let's say you put $1 million into the ATM machines, and we'll talk about returns on that here in a minute, what you're going to get on the cash flow there. Then you get $800,000 of that loss in year one. Let's imagine over here, you had an $800,000 either capital gain, right? And or income. Walk us through what that 800,000 on the ATM loss would offset on the other side.
So it is not one size fits all. And I've actually taught some courses on this where you can learn to align your tax impact with the right kind of income. So let's say your passive losses will offset passive income or passive gains. Your active losses will offset active income or active gains. So let's say you were a passive investor in a multifamily apartment deal and that thing sold. Now you could take another passive loss. Let's say you made an investment in ATMs and you got all of that depreciation. Depreciation equals passive loss. So now you show up with, $500,000 of loss on your K1. You get to offset the gain of that real estate sale with the loss from your depreciation from the ATM sale. So when you learn how to match up the different tax losses with the different incomes or gains, that's when the magic happens. Because many times, especially if you're paying some kinds of income, when you're paying 37% tax, it's not as bad when you have a capital gains where you could only be paying 20% tax. But still, even a 20% tax, if you can wipe out that tax and get that money to work for you instead of you working for the money or you working for the government, that's a big deal. And many times that becomes your first year's biggest return is simply your tax savings.
Excellent. So let me unpack that, and then we'll try to make it a live scenario. Okay, a couple scenarios. So passive losses, right, offset passive gains. Active losses offset active gains. So let's say I put $1 million into an ATM machine investment. We get $800,000 loss. This is a passive deal. I'm investing with Dave Zook. I went to the realestateassetinvestor.com. I'm an accredited investor. I said, great, let's do it. We got that bonus depreciation this year in 2023. And then I had another passive deal over here, Dave, that I just had an $800,000 gain on, right? And they happened to exit in the same year. Are you saying because they were both passive that essentially, check with your CPA and make sure everything lines up, right? But are you saying that capital gain of 800,000 can be offset with this passive loss of 800,000?
100%.
Excellent. Second question. Now, let's say we didn't sell that asset, but that passive asset that was outside was a multifamily property. It produced $80,000 of passive income. Could this passive loss that I did with the ATM offset that passive income?
Absolutely.
Okay, that's great.
A good test is passive offsets passive, active offsets active.
Regardless if it's passive cash flow or passive gain, those go hand in hand. Okay, now let's move to active, right? So now I'm like, hey, I want to be the Dave. I want to run my own fund, or I want to be the GP, and I do some ATMs myself. I put $1 million in, and then over here I do my own multifamily property. I'm running the deal. I'm the GP, general partner. You're basically doing all of it yourself, and I'm same thing here. The income off of both of these can offset on the losses over here versus over here?
It depends. So if you're active on the ATM side and that's active income to you, then you could, if you were a real estate professional and you did the 750 hours and you logged your time and did all that, and that became an active an active deal for you, an active business activity for you, then you could. But if you were going active to passive, you could not.
Yeah,
So as
yeah.
long as you, as long as your investment aligns with your asset, and your tax impact aligns with your cash flow, your equity gain, your capital gain, it works.
Yeah, so let's break that down for everyone who's curious. So that's called real estate professional. Doesn't necessarily mean you are getting a real estate license. It just means that, like Dave said, you're spending 750 hours or more that you're documenting in the active working on those investments, not just through a passive investment, right? And also too, if you're that W-2 and you're earning, Dave, let's talk about this for a second, right? I'm earning, like I'm a doctor, or I'm an attorney or something. Talk about the nuances there, especially if you're working for another company, and then add if you're married and have a spouse who you may want to work through. Talk about that strategy, Dave.
Yeah, so there are rules. There are rules to the game. And just make sure you know them. Let's say you are a W-2 and you're putting in 60 hours a week, then probably being a real estate professional isn't going to work well for you. But let's say you have a wife and your kids are now going to college, or your wife has 15 hours a week that she could dedicate toward your real estate activities. That would get her to the point where she could qualify and she could be a real estate professional. Again, there's rules. Just make sure you know the rules. But that's another way that you could become a real estate professional. You're married. Your wife becomes a real estate professional. Now she can take those real estate depreciations, losses, and all that, and make it work for you. Now, I will tell you that real estate professional isn't one size fits all, and it doesn't always work for you. There's times when you want to be a real estate professional. There's other times when you do not, and it's an annual election. You can be a real estate professional in 2023, and you can choose not to be in 2024, and you can choose to be in 2025. So make sure you know the rules. Make sure that you have it working for you. When you're acquiring real estate, many times you want to be a real estate professional. When you're selling real estate, many times you do not want to be a real estate professional. So it's not the keys to the kingdom, and it's not one size fits all. You got to be strategic about it.
Interesting. We're going to talk about why that is in just a second. But if you want to take action right now and get with Dave Zook, you can go to therealassetinvestor.com, therealassetinvestor.com. So Dave, let's break that down again. Okay. So I'm married. My wife is staying home with the kids, and we were like, hey, look, we've got these real estate investments that we've actively invested in, our ATM machines. We want you to spend 15 hours a week. And I imagine that could be books and records. That could be following up with vendors. That could be literally going there and renovating their apartment complex. That could be probably a number of things that have to be documented within profit and loss statements, banks and bills, and utilities and vendors, right? So just walk us kind of what those steps are, and then second, clarify that, hey, I'm making $500,000 as a W-2 employee. My wife was making zero before, right? Just staying home. But now she's putting towards 15 hours a week. And let's just say hypothetically, we had enough $500,000 loss on some cost seg. We accelerated some depreciation. That now it's considered active, and that active can offset my W-2 500,000. Am I hearing that right, Dave?
Yeah. So if you're doing that, if you've got the cost seg that's active, because you've got real estate that's now considered an active business because your wife's a real estate professional, you could take that $500,000 loss, offset the W-2 income that you're making from your dental practice, your legal, your W-2, whatever, and you could wipe out the tax liability on that W-2 income.
Amazing, right? That's incredible. If you didn't quite catch all that, please rewind that. It's so powerful, right? It's so powerful to know that these investments that you're investing into, next year it's 60% for the bonus depreciation, but still, if you had $500,000 of earned income that you're about to be taxed on, let's say 35 to 40%, and you could even get $50,000 off or $60,000 off by having your spouse become a real estate professional, putting in those 15 hours a week. classifying, filing joint, check with your CPA and all this stuff, right? We're just kind of laying out the vision for this. You want to make sure you get the details, like Dave was talking about in the beginning, and so am I, with your CPA and your particular tax return. But that's what the tax-free way of building cash flow is. Anything else to add to that, Dave? And then also talk about why you wouldn't want to do this if you're selling and that year not elect to be a real estate professional. Make sure we understand that.
Yeah, to add to what you said, one of the things that makes that what you described there is like one of the most powerful ways that you can use real estate professional status, because one of the reasons is because W-2 income is one of the hardest to protect. That's one of the hardest incomes to protect. So you got W-2 income, and you're going to get taxed unless you get really strategic, and that's one of the ways you can offset the tax liability on your W-2 income. So why you would not want to be a real estate professional when you're selling? Okay, and this is personal here. I mean, you got to look at your personal situation. Then you got to ask the question: do I want my real estate activity to be passive or active? And then you got to ask yourself, is it passive or active? And you got to justify if it is or it is not in case of an audit. But one of the reasons you would not want to be a real estate professional when you're selling is exactly the same reason that we just shared about being a W-2, having W-2 income. Active income or ordinary income is harder, much harder to protect than passive income. So when you're a seller and you're active, you're a real estate professional, and you sell a bunch of real estate, you're going to get taxed at, most likely at 20% for your capital gains. And not only are you going to get taxed on the gain, but you also got to recapture all that depreciation you took over the last however long you held the building, 1 year, 5 years, 10 years, 20 years. Your basis could be down to zero. And so now you're not only going to get taxed on the gain at the sale from, point of purchase to point of sale, but you got to recapture all that depreciation. You're going to get taxed on all of that. So the reason you would not want to be a real estate professional if you were, totally a seller and you weren't flipping or buying or doing 1031 exchange, any of that stuff, because when you become a seller, all of those gains then would be considered passive, which you can then offset using some other passive activity. Again, tons of options when you're talking passive losses. You can invest in a whole bunch of stuff and get passive losses. Only a few are available to you, and we're talking oil and gas are available to you when you start talking active.
Okay, so let's clarify that. Okay, so I buy a building for $5 million, right? And for the first 5 years, I'm accelerated depreciation. I'm taking the 8% bonus depreciation. I'm offsetting my W-2 income. My wife's working, but in year 5, or we're going to sell in year 6 or 7, whatever, right? Are you telling me that then I could just elect to not be a real estate professional in year 6 or 7? And then when I go to sell, it's not necessarily going to be classified as ordinary income? I'm trying to figure out when you elect or not elect, or is it more on a case-by-case basis for what asset that you own? Walk us through that, Dave.
It's an annual election. So every year you have to elect in or out. And so you got to check the box. And, you want to make sure that it aligns with what you do. Like, say, for instance, if you didn't want to be that real estate professional, you would just say to your wife, hey, that activity that you were doing last year, we're going to get somebody else to do that.
Pause. I got what you're saying. I get you can turn it on, turn it off, right? And you're not doing that. You're not putting the hours in. You're no longer doing it. I guess another way to put it is, if you're ever selling an asset, is there ever a time that you want to elect to be a real estate professional? Or are you saying basically, hey, 99% of the time, just turn it off. I'm going to be selling in 2025. Great. 2024 is the last year that your spouse is a real estate professional. Just turn it off. Sell in 2025, and then in 2026, perhaps you're electing again. Am I following that right, Dave? Or is there a time where you'd say, no, keep the real estate professional status going?
There are very, very few times when you would want to rather have that be ordinary income than passive income. And if you were wanting to be an oil and gas guy for the rest of your life and invest in oil and gas the rest of your life, then maybe. But there's, very few times when that would actually make sense to elect to have that considered ordinary income rather than passive.
Got it. Okay. Now the next question I have for you is this. All right. So are there certain assets that you guys are buying that you're deciding to accelerate the depreciation? Or are you always accelerating no matter what? Or certain ones you're electing to do straight line? Is it dependent upon the model? If I'm selling within 1 to 3 years, then I'm just going to keep it straight line. If I'm holding for 5 to 7 or greater, then I'm going to do accelerated to give the chance for that depreciation to mature that I've taken. Walk us through your strategy of using cost seg versus not.
Yeah. So if you're a flipper, it probably doesn't make sense. But if you're holding for 2 to 5 years, I believe it would. And again, it can depend on your business plan, what you're doing. It can depend if you're a value add, and as soon as you're done with the value add, you're going to sell. So timing is a big thing. But there's seldom, if you're a buy and hold investor and you're investing for cash flow, but there's seldom a time when a cost seg study does not make sense. There's even if you're at the point where you do not need all of that cost seg depreciation, that accelerated depreciation in year one, it just rolls over into year 2 and year 3. But again, look at your business strategy and just, ask yourself that question. Seldom does it make sense when you're holding that asset, or seldom does it not make sense when you're holding that asset for 2 to 5 years.
Okay, now let's wrap this up with a bow and keep our promises about ATM returns with the realassetinvestor.com with Dave and kind of what people can maybe expect there. So, all right. So I want to make sure if I can take real estate professional status, do that. B, if I can cost seg, do it, generally speaking, right? C, if I'm selling something, I know I'm going to be selling something in that year, elect to not be real estate professional and pass that back out to essentially shift and get all of ourselves in a better tax position. Wrap that up or clean that up at all, Dave. I might have missed something, and then add to it. What are the ATM returns that you're typically seeing with investing with you guys?
Yeah, so ATM returns somewhere around 25%. Cash on cash return. Now, when you are comparing to a brick and mortar building, a multifamily apartment building or self-storage or some of that, then you really got to use the IRR. And I'll explain why, but that's around a 19% IRR. The reason you got to go with the IRR is just simply because your cash on cash return of 25% does not take in consideration the fact that you're losing the value of your equipment over that 7-year contract period. And that's what it is in our ATM business. You're buying ATMs, we're contracting with you for 7 years, and you're going to get cash flow from that for 7 years. And so it's kind of like if you were to buy a half a dozen laptop computers 7 years from now, what's that laptop computer going to be worth? Not much. Yes. Well, that's what happens when you're investing in an equipment like this in ATM machines. They depreciate. That depreciation we're talking about is real, and they depreciate down to zero.
But hold on, that's really cool though. If I'm looking for cash flow right now, I'm like, hey, if I can just free up my time, my energy, and get enough passive income coming in, so I don't have to work anymore. I can go at least work on the W-2 job or work whatever I'm working, and I can start to do my businesses that I want to do or other business and ventures. And my main goal is just I want cash flow as much as I can get right now, Dave. You're saying that, hey, 25%, I put $1 million in, $250,000 for the next 7 years is pretty consistent. Year 7, that equipment goes to, let's say, zero. It's no longer working, right? Just say hypothetically, right? Some might go lower, some longer, whatever, right? But on average, at that point, I look up and I'm like, okay, I've either have had to save another $1 million, right? Because that 250 might be going away. Am I reading that right? Like essentially that million has gone away, or what?
That could be the case, but that's not how we play it. So let's say by year 3, at the end of year 3, when you consider the cash flow plus the tax impact, by the end of year 3, you get your principal back in your pocket. So now you get an additional 4 years of free cash flow behind that. And what we do, what I do, and what a lot of my investors do is they use the ATMs and they sort of ladder them, right? So you take the depreciation, most of the depreciation in year one, then you start getting that income, and then next year you say, okay, well, I'm going to get taxed on whatever. Let's just use round numbers. My tax bill, I'm going to get taxed on $100,000. So I'm going to invest in another ATM to knock down my tax liability. The following year, oh well, I sold an apartment building. Now I need 2 or 3 more ATMs. So we're constantly playing that game, and not just with ATMs. But ATMs is a prime example because they're very aggressive on the depreciation side. But you can start to ladder and really manage your tax liability while at the same time building massive streams of income.
Absolutely love it. We're talking with Dave Zook, ZOOK, therealassetinvestor.com, therealassetinvestor.com. Dave, are you ready for the lightning round? I know we covered a whole bunch of, geeking out with some tax here, but I think our listeners might be ready for it. You ready for it?
Let's go.
All right. Knowing what you know now, if you could go back to your 25-year-old self, what's the one golden nugget and make sure you tell yourself to do?
Invest with great people. Find the best people in any asset class, invest with those people. Make sure you get around good people. Look, I tell my teenagers this: you get to be around the people that you hang with. And a prime example of that is, I asked my self-storage operations team. I asked one of the guys, the kind of lead guy there. I said, "Hey, what else do you invest in?" And he looked at me like, "What are you talking about?" Like, I don't invest in anything else. I've only ever invested in self-storage. That's the only thing. I mean, that's all I know. That's the kind of guy. And when you can invest with somebody who's got their one thing and they're a great guy and really ethical guys, look, that's a huge shortcut. I'll go with that one.
I love that. That's fantastic. Question number 2, what's the number one book you've recommended the most in the past year or gifted the most?
Number one book that's going to relate to everyone listening to this. It's got to be Rich Dad Poor Dad.
Love the book. Question number 3, what are you most curious about right now?
I'm curious about AI and how it's going to play out in our future. I'm curious about digital assets, currency, what's going to happen to our currency, those kinds of things.
What's your biggest frustration when it comes to capital gains tax or the 1031 exchange?
Capital gains tax is not frustrating to me at all. It's one of the easiest tax liabilities to eliminate. The 1031 exchange, the frustrations there. I mean, it's clunky. I mean, there's rules and there's windows. And here's the thing: when you hear the time windows, and you got 45 days, you got 90 days, you got 180 days to do the deal, whatever, half a year. It sounds like a long time, right? It's not. When you're dealing with $5, $10, $20 million assets, it's not a long time, and stuff happens, and it's just it's just clunky.
Absolutely. Could agree with you more. That's why we founded Capital Gains Tax Solutions, to eliminate the need for the 1031 exchange and to give you alternatives by using something called the Deferred Sales Trust, so that you can invest into ATM funds, multi-family funds, mobile home park funds, self-storage funds. You can go stocks, you can go into crypto, you can start your own business. In other words, you can have flexibility to optimize your cash flow and your tax flow at timings that make sense for you, versus being in a shotgun wedding, 45 days, 180, not a fun place to be in. You can learn more right now by going to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. Hey, last question, Dave. After all your success, helping all the people you've helped, what's the number one practice for you, your habits, your rhythm to stay centered in your values and stay encouraged to charge forward to reach higher heights?
So I believe that wealth, I actually was just speaking at a generational wealth conference over the weekend, Friday, Saturday. And, one of the things that I talked about in one of my slides was, what is true wealth? And, then I talked about, family and relationships and health and emotional health and spiritual, and then finally money. And the interesting thing is, if you've got the money and you're missing one of those other ones, that's going to steal a lot of the joy in your life that money's not going to be able to buy. And the good thing is that you don't have to pick one. For me, and I told you my personality, for me, the easiest one has always been the money. It hasn't been the family. I got to work on my relationship with my family, and I got to, and I have a great relationship with my wife and kids, but I got to work on it. It takes discipline, and it takes, what do you call it? It takes you being, it takes you being active, or intentional is the word I was looking for. It takes me being intentional. I don't have to be intentional about making money. That's built in. And so just being intentional about those things, because when you don't have those things right, having the money isn't nearly as much fun. And so, that's one of the things I remind myself to keep myself centered, is like work on those things that really matter. Because look, at the end of the day, I mean, there are studies that talk about how when you go from whatever $75,000 and you go from that to $150,000, there's a certain amount of joy, a certain amount of happiness, a certain amount of quality of life that you get from going to 75 to 150. And then there's another round, and of course you'd have to adjust this for inflation. I heard this like a number of years ago. So these numbers, you got to take them wherever, but just follow me on this. Then there's another place, from 150 to 250. I mean, you can drive better vehicles, you can take nicer vacations, just, all of the above. You can just do more fun stuff with family and all that. But once you get to $1 million or more, or of course, again, adjust for inflation, whatever, let's just call it $5 million. And north of that, the happiness thing doesn't follow the amount of wealth. Like, I can't tell you that I'm happier with my wealth today than I was 2 years ago. I mean, it's grown a lot, but so to remind yourself to work on the things that matter. And, of course, we all want to grow. We all want to do cool stuff. We all want to buy buildings and sell buildings for a profit and all that. And we should, but just, some of us have to remind ourselves to work on the things that matter, and not always about how do we make more money.
Dave Zook, I want to thank you for being on the show. So much wisdom there. I'll leave that last piece was worth every bit of the show. Thank you so much. Don't let the pursuit of money wealth, right? Income wealth, steal the joy from the things that money can't buy. So well said. And by the way, it seems like it's kind of like you can be passive in your wealth building, but you can't be passive in your relationship building, right? Or the passive dad, right, or the passive, husband. You've got to be making sure that's the one thing you cannot delegate, right? Don't trade what's unique to you, right? And I'm talking to all of us here, myself and Dave and everyone listening. And for something someone else can do is the way I've heard it put before, right? So that being said, Dave Zook, thank you for being on the show. For our listeners who want to get in touch with you, would you remind them one last time what's the best place for them to find you?
So go to our website at therealassetinvestor.com. Our email address that'll tap you right into my team is info@therealassetinvestor.com. If you send us an email, someone will respond.
Amazing. Thank you, Dave Zook. Also want to thank your listeners for listening to another episode of the Capital Gains Tax Solutions Podcast, or watching us on our YouTube channel, Expert CRE Secrets, or the Capital Gains Tax Solutions YouTube channel, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is an amazing way for you to exit highly appreciated assets and then invest with amazing folks like Dave Zook into ATMs, car washes. We didn't even get into that. Other real estate assets to create and preserve more wealth. Go to capitalgainstaxsolutions.com to get started today by building a capital gains tax exit plan. Also look for the book that came out. Kevin Harrington from Shark Tank's in the book. I have a few chapters and some other really smart multifamily commercial real estate financial advisors in the book too. Check that out. Thank you for listening.